Welcome to Talk Tickers, where we break down the earnings calls that really move the market. Today, we're diving deep into Instacart's third quarter. All right, let's get right into it. Instacart's latest earnings report looked like a home run. I mean, they beat expectations, they raised their guidance, and the stock just shot up over 7% before the market even opened. But then, poof, all those gains just vanished by the end of the day. So what happened? What spooked investors? That's what we're here to figure out. Let's dig in. Okay, first things first, let's look at the numbers for Q3. And on the surface, wow, they looked really good. A classic beat and raise, ticking all the right boxes for Wall Street. So take a look at this. Instacart absolutely delivered a solid beat on both the top and bottom lines. You've got GAAP EPS, that's just the profit per share by the book, coming in at 51 cents, just squeaking by the 50-cent consensus. Revenue also beat expectations, hitting $939 million. I mean, this is pretty much a textbook beat. Okay, but here's where the story gets really interesting. Check out the order growth. It accelerated to a massive 14% year over year. I mean, that is a huge number. And what it tells you is simple. More people are using Instacart. That's the lifeblood of the business, and it's exactly what investors want to see. And, of course, all those new orders, well, they add up. We're talking about gross transaction value, or GTV. Basically, the total price tag of everything sold through the platform. And that jumped 10% to an incredible $9.17 billion for one quarter. Yeah, that's a whole lot of groceries. And this right here, this is a beautiful example of what investors call operating leverage. It's when your profits grow even faster than your sales. So as Instacart gets bigger, it gets more efficient. Their adjusted EBITDA, which is a great way to look at their core profitability, soared 22% to $278 million. That is the power of this business model in action. So, you might be asking, where's all this money coming from? Well, think of it like a car with two engines. The main one is the transaction revenue, the fees they charge on orders. That's the bulk of it. But the other engine, the high-octane one, is their advertising business. It's super high margin, and it's absolutely crucial for their future profits. Okay, the numbers are strong, so let's shift gears and talk about the bigger picture. The story management is pitching. Because to really get why the stock did what it did, you have to understand where they see this company going. And this quote from the CEO, Chris Rogers, says it all. He was practically shouting this from the rooftops on the earnings call. They are not just a delivery app. They see themselves as a technology partner, the company that's building the entire digital backbone for the grocery industry. It's a huge distinction. So how are they doing that? Well, their whole enterprise strategy is built on these 5 pillars. They're offering grocers the whole shebang: custom online storefronts, fulfillment and delivery logistics, their ad network, they call it Carrot Ads, and even fancy in-store tech and AI tools. The big idea here is to make themselves so essential that grocers literally can't live without them. So, looking forward, management is putting their money where their mouth is. They're focused on 3 big priorities. 1, make it cheaper for you and me to use, which brings in more people. 2, really push to get more grocers signed up for all that tech we just talked about. And 3, keep growing that super profitable ads and data business. All right, so let's recap. We've got great numbers, and we've got a really compelling story about the future. So what gives? Why the fade? Let's look at how the market actually digested all this, because it's a tale of 2 very different trading sessions. This chart right here tells the whole story. It's a classic case of buy the rumor, sell the news. The stock pops before the market opens, everyone's excited, and then bam, the opening bell rings and the sellers just pile in. We're talking over 12 million shares changing hands. A lot of investors clearly decided to take their profits and head for the exits. And, you can't really blame them for being a little nervous. Let's put this in context. Even with this great quarter, the stock has been, frankly, a bit of a dog. It's down almost 22% over the last year. Meanwhile, the S&P 500 is up over 17%. That's a huge gap, and it makes people quick to cash in on any good news. And I think we found our smoking gun. This is probably the biggest reason for that rally fading. Management's guidance for the next quarter was fine. GTV growth looks solid, but, and this is a big but, the outlook for that super important high-margin advertising business was a little softer than people wanted to see. They're guiding for 6 to 9% growth. They blamed macro uncertainty, which is kind of a catch-all, but it was enough to pour some cold water on the party. Okay, so we've put it all together: the strong quarter, the ambitious long-term plan, and the market's kind of lukewarm reaction. So what's our take? What's the call on cart from here? Okay, analysis is great, but now for the fun part. Let's talk about the trade. What do we actually do with all this information? So our official rating on this is going to be market perform. Here's why. We love the execution, and the enterprise strategy is genuinely promising. But it's a tough competitive world out there, and with that slightly weaker ad growth forecast, we think the stock is pretty fairly valued right where it is. It's a good company, but not a screaming buy at this moment. But if you're looking for a more interesting play, here's an idea for you: a pairs trade. You'd go long on Instacart and short one of its competitors, maybe a company that's more of a pure delivery service. The thinking here is that Instacart's deep tech integration with grocers is its secret weapon. It gives them a real long-term advantage over companies that are just moving bags from point A to point B. If they keep signing up big grocers to their platform, Cart should outperform. Now, what's the risk? Well, if that adoption slows down, or if a competitor copies their playbook, this trade could definitely go south. And as always, just a quick reminder, this analysis is for informational purposes only. This is not financial advice.